Hey everyone, it's Tony Leonardi here, certified financial planner, professional from Newtown, Connecticut, and author of A Smarter Way to Retire, back with another episode of A Smarter Way to Retire podcast. I hope everyone had a chance to see last week's first quarter webinar, Taxes and Roth Conversions 2026 version. If you missed it, the video is now available on my YouTube channel, or you can listen on Apple or Spotify podcasts. It's a comprehensive retirement planning session that includes Roth conversions and 4 other tax strategies, including a bonus strategy that I threw in about capital gains taxes. I think you'll enjoy it, so look for it on my YouTube channel. As I was presenting the webinar last week, it dawned on me that in most of the retirement planning I do, pretty much everyone has the same issue. And why is that? What causes almost everyone to fall into the same trap at retirement? What advice has everyone been listening to that is leading them down this road right into the trap? And why does everyone step into this same trap? What trap am I talking about? Let's call it the 401k tax trap, or the so-called retirement tax torpedo. If you've been saving aggressively, maxing out your 401k, and doing everything right according to what you've been told all these years, this episode might completely change how you think about retirement planning. Because most people think that the real risk in retirement is running out of money, and that is a fear. It's a very legitimate fear and something that we need to plan for. But the big trap that most people step in is the running out of tax flexibility trap, the tax torpedo. For decades, the message has been pretty simple. Put as much money as possible into your 401k. You get a tax deduction, pre-tax money going in, you get tax deferral on your investments, and you'll probably be in a lower tax bracket in retirement, so that's just the perfect plan, right? Well, for many people, especially early savers, it is a fantastic tool. This is exactly why I cover it in chapter 2 of my book, A Smarter Way to Retire, 10 Steps Towards a Confident Financial Future, building that tax-deferred foundation. But did you realize that when you were filling up your 401k all these years, your tax-deferred bucket, you were making a decision to exchange a fairly low capital gains tax, usually around 15% for most people, not to mention a step up in basis for your kids when you pass away, which could eliminate the capital gains tax entirely. You made a decision to exchange a low capital gains tax for a high income tax. Now think about that for a minute. All those stocks and funds that you purchased, you could have been taxed at 15%. Instead, you chose to have them taxed at 22, 24, 32, even 37% income tax. And when you pass away, you pass that tax burden onto your kids in their tax brackets, sometimes even higher than yours. Did you mean to make this choice, or were you just blindly following conventional wisdom? I think the latter. I'm not saying that you made a bad decision. You did get pre-tax contributions, you got tax deferral on your growth, and hopefully a company match. That's the key. And you probably built up a nice big nest egg over the past 30 years or so. But here's the big question that nobody really asks. What happens when the 401k works too well? What happens when decades of compounding and saving turn that account into $3, $4, even $5 million? Sounds fantastic, right? Is more really better in this case? Keep in mind, starting at age 73, the government requires you to withdraw money from your traditional retirement accounts, including your 401k, not because you need the money, not because the market's been great, but simply because the IRS wants its share. Your partner, your 401k partner, has been waiting patiently for their share, and now they're running out of patience. The first withdrawal at age 73 is roughly 4% of your account balance, and it goes up from there. So imagine you retire with, let's say, a $3 million 401k. Your first required withdrawal at age 73 is $120,000. And it's all taxable as income, not capital gains, whether you need that money or not. Add Social Security benefits, maybe some investment income or a pension, And suddenly, many retirees find themselves earning on paper almost as much or sometimes even more than they were when they were working. Again, sounds great, but there is an issue. It's a tax issue. The very account designed to reduce taxes while you're working can recreate your highest tax years in retirement, and that's not what you want. This is what we financial planners have called the 401k tipping point. So this is where we need to talk about the 3 tax buckets every smart retirement plan should have. And I talked about this in last week's webinar. You should have a tax deferred bucket. That's your 401k, your IRA. It's great for saving now, but it comes with a future tax bill. Some people say they're the best place to save, but the worst place to have money when you retire or even die. The second bucket that you should have is a tax-free bucket. That's your Roth IRA, life insurance, muni bonds. Money grows and can come out tax-free. That's pretty nice, right? The third bucket is a taxable bucket. That's like a brokerage account where you pay capital gains and income tax on dividends as received. That's where you're growing your taxable stocks, your taxable funds. And on your taxable bucket, you get a step up in basis at death, which can totally eliminate the capital gains tax on that account for your kids. That's an added bonus. So you have 3 buckets, your tax deferred, your tax free, and your taxable. Most people put almost all their money into their tax deferred bucket because it feels like the obvious best choice. But here's the problem. You can actually end up in a higher tax bracket in retirement than you're in today, especially once RMDs start forcing large withdrawals on top of Social Security. That's why filling all 3 buckets in a balanced approach early on in life is so important. Filling in those buckets in a balanced approach is easy when you're young because you can make that conscious decision. Have your kids or grandkids reach out to me and make sure that they're filling their 3 buckets evenly. This will help them avoid a lot of the issues that you're dealing with now. And even after retirement, you can balance out your 3 buckets. It's a little bit more difficult now, but you can strategically move money from one bucket to the other, from the tax-deferred bucket to the tax-free bucket through Roth conversions. And that can give you so much more tax control than you had before. Here's where it gets even more interesting and more frustrating. Most retirees assume tax brackets work normally in retirement. But once Social Security kicks in, things change. Social Security benefits become taxable depending on your other income. Yes, you get a new tax deduction thanks to the big beautiful bill, and that helps to offset some of your taxes on Social Security, but the concept here still holds. And I think this is why Congress didn't want to give us no taxes on Social Security, but instead an extra deduction. They wanted to keep that torpedo in place. They know what they're doing. So when you withdraw from your traditional IRA or 401k, that withdrawal can cause more of your Social Security to become taxable at the same time. So $1 of withdrawal doesn't just add $1 of taxable income, it can add $1 plus another 85 cents of taxable income. You see how this compounds here. Your effective marginal rate can suddenly jump from 22 to 24, or even higher, 32, 37. And that sudden spike is what we call the tax torpedo. It's invisible, it's confusing, and it hits disciplined savers the hardest. The ones who did everything right get hit the hardest. So this changes how we should think about retirement. The goal shouldn't simply be to accumulate the largest 401k possible. The goal is to build wealth across different tax buckets, the 3 tax buckets. So you have some choices later on. You have some tax flexibility later on. Like I said earlier, balance your tax deferred, your taxable, and your tax-free buckets. Withdrawals from your tax-free bucket, like your Roth IRA, don't increase Social Security taxation. They don't trigger Medicare premium surcharges, those IRMA surcharges we've talked about so many times before. They don't force income on you through RMDs. And they don't saddle your kids with big income tax issues when you pass away. They give you the ultimate tax control. And in retirement planning, control is everything. This is exactly what I walk through in chapter 10 of my book, Treating Your Retirement Plan as a Living Document That Needs Regular Adjustments. Here's the part that surprises most investors. The most valuable tax planning years in your entire life may be the decade after you retire, but before RMDs begin. Let's say, for example, that you retire at age 63 and RMDs kick in at 73. That 10-year window, that's the magic planning window. During that window, your income is often much lower. You can intentionally move money from a traditional 401k into a Roth account through strategic conversions. You voluntarily pay moderate to low taxes today to avoid forced higher taxes later. That's the ideal. Many retirees who understand this magic window save hundreds of thousands, if not millions of dollars in lifetime taxes. Not because they earned higher returns, but because they managed where their money lived, what buckets their money lived in. So the takeaway isn't that 401ks are bad. Far from it. They're one of the greatest wealth building tools ever created. But like any powerful tool, they work best when used intentionally. Retirement success isn't just about how much you save. It's about how much your savings will be taxed when you retire and for the next 30 years. And for families that like their kids and love their grandkids, filling your tax-free bucket is a great move for the next generations as well. Remember, IRAs and 401ks are one of the best places to accumulate money, but one of the worst places to retire or die with money. The IRS knows this. Are you going to let them win? So that's the tax torpedo. If you have any questions about how this fits into your unique situation, please let me know. Reach out to me on my website. If you have any topics that you'd like me to cover in future episodes, please let me know. And feel free to leave your toughest questions in the comments below or reach out to me for a more personal response. Make sure you subscribe and turn on notifications. And don't forget to grab my free comprehensive guide, Roth Conversions Playbook 2026 edition. You can find it on my website, LeonardiFamilyWealthCare.com, Roth IRA Conversion Playbook. Thanks for joining me, and remember, there is a smarter way to retire, and we'll see you next week.
Securities and investment advisory services offered through Mosaic Wealth, Inc., member FINRA SIPC. Mosaic Wealth is separately owned, and other entities under marketing names, products, or services referenced here are independent of Mosaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Mosaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.